are at the forefront of people's minds. At times this year, I think even LME traders have been scratching their heads as they watch the market fly. And analysts have admitted that making price forecasts is a little bit like pinning the tail on a donkey. In a poll at the start of this year that we did at AMM, analysts pegged average copper prices for this year in a range of just below $5,000 per ton to $7,000 per ton. Their estimates have proved to be wildly conservative, and they have steadily had to increase their estimates as the year has progressed. The average price for the year to the end of October is now around 7,200, and that was before the record highs last week. The analysts are still tweaking, in fact. Just yesterday, MF Global raised its price forecast for next year, and the timing was pretty was pretty amazing given what was happening on the market at the time. Anyway, amidst all of this chaos, consumers of copper are left to struggle with the volatility. $500 move yesterday, swings of several $100s in a day is not unusual, and with that, soaring raw material costs. So that's a sort of a summary of the last week or so. But what am I going to look at today? Well, I suppose I'd like to just look at the reasons for the rise in prices and what is driving the market at such the phenomenal rate that it is moving, and consider and in order to do that, I'll need to look upstream, and because that is where the tightness is creating the squeeze downstream. It would be wrong not to look at China's role in the scenario, and I suppose a more pertinent issue for us today is how long will they sit out of the market. They have not been buying much copper in recent months. And then there are other issues on the horizons which have caused alarm in the market, such as the planned physically backed exchange traded funds, and what their potential effect on demand could be. And then I'd like to finish with a glance at the prospects for 2011, and what forecasts the analysts are making. During the presentation, I will draw on opinions I have heard from traders, that is the physical and the futures traders, and market participants in general, as well as forecasts by Metal Bulletin research analyst Andy Cole. American Metal Market and Metal Bulletin are part of the same group, and I asked Andy for his opinions on the growth in China and his forecasts for the market deficit. So that they are not necessarily my opinions as much as people with a far greater macroeconomic expertise, I suppose. Anyway, what has led to the price surge of the last 18 months? And I suppose the easiest way to explain that is to say, well, there is a market deficit. Metal Bulletin research is predicting a deficit for this year, and for the next few years. The refined market deficit for next year will be 305,000 tons, rising to 390,000 tonnes in 2012. Now, part of the reason for the deficit started last year with the Chinese restocking that led to a far greater recovery than I think anyone could have expected. Part of the deficit is actually visible in the drawdown in the exchange stocks. LME stocks peaked in February at around 550,000 tonnes, and they are now just above 360,000. COMEX stocks also peaked in February, and they are now around 74,000 tonnes compared with above 100,000 tonnes earlier in the year. It's also maybe easier to explain where that deficit has come from, where that drawdown in stocks has come from, by looking upstream. And this is where the experts see a shortage of material that is affecting the production of refined copper. It all comes down to what's coming out of the ground. The mining industry is underperforming. The red line on the graph on the left-hand side is what is required, and the lower line, the blue one, is what we can rely on to be produced. That is according to Metal Bulletin Research forecasts. And so Metal Bulletin Research is actually forecasting a 5 million tonne per year gap between firm mine supply and required mine supply by 2020. And that equates to actually more than 4 escondidas, which is a pretty phenomenal shortage. Rio Tinto actually puts the supply gap as at 6 million tonnes per year. Copper miners have always been vulnerable to disruptions and shortfalls, and price rise in copper has meant that worker action over wages has increased, particularly in Chile. At the moment, Colwezi the workers at Colwezi are striking. The mine is not affected because they are using non-unionized and contract workers, but even so, that is causing concerns in the market that the longer that goes on, that could have an effect on supply. And Colwezi is not the only mine, I should add, in Chile that is facing wage negotiations in the next few months. But there is more to the disruption than just industrial action. Falling ore grades at aging mines are causing a squeeze in concentrate supply. Global mine utilization rates are down from 95% in the late 90s to around 80% now. That is on the left-hand graph. And the main cause is falling head grades. And this shortage is already leading to smelter production cutbacks, particularly in China. It is perhaps surprising that the higher prices of the last few years haven't actually encouraged greater exploration or development of copper deposits. And actually, even just this morning, Tom Albanese, the chief executive at Rio Tinto, has admitted at a conference here in New York that there is a significant lag in the growth of copper resources, and he attributed that to the aging of existing deposits, but also to the risks of operating in locations where there are new projects, such as the Congo. The prices were relatively low in the 1980s and 90s, and there was a period of underinvestment, and the market has been very slow to react, even in the last 5 years. Rio's still seeing its mined copper output falling. It fell 19% in the third quarter compared with the prior year. And he noted the challenges of operating in the Congo, for instance, and the energy shortages, for instance, in Zambia. The African copper belt has not proved as friendly to new exploration as many had hoped. But even so, at the same time, while the miners have been slow to catch up with their investment, demand has been growing, and Metal Bulletin research shows that that graph shows that global demand growth has been averaging about 2.9% since 1960. Some years there has been growth of 4% plus per year. And even coming out of the worst economic crisis in a generation, there's not even a wobble on that chart. And part of the reason for that, as you all know, is China. Aside from the issues we have in the short term with China, analysts expect the economy to continue to grow at a robust pace. Metal Bulletin research sees no reason why the voracious growth will stop. They are expecting a soft landing as the government negotiates the risks. Now, per capita copper, and part of the reason for their confidence and their optimism is that per capita copper consumption is still half that of mature economies. The country still has cities to build, and it is transforming its electricity sector. Metal Bulletin research, in fact, puts copper's growth rate at 6% per annum, and they say that is erring even on the cautious side. All that said, the country has been absent from buying scrap and primary copper since August, and the spreads between primary and secondary prices have been widening, which many market participants say is an indication of the weakness of the country's demand. As I said earlier, October unwrought copper imports hit a 12-month low and was some 25% lower than September. The fact that the country hasn't needed to buy very much since August is perhaps an indication of the size of their inventories on the ground. Traders and analysts estimate to me that the range is between several 100,000 tons and several million tons, and that has spooked the market. Given that we are now approaching the end of our year and that it will be China's New Year celebrations in February, traders have been cautioning to me that there might not be a significant resumption of buying from China until after the national holiday. Now, that is ignoring the dramatic falls in prices we had yesterday, but when they do restock, it usually has a tremendous effect, and in 2009 their restocking was the main driver for prices rising to well over 7,000 tons from 2,800 tons at the end of 2008, and so their buying is expected to be temporary. They are very opportunistic buyers, and they exited when prices were rallying, when they started to really rally. And so it'll be interesting, as I said just now, it'll be interesting to see if they do return after this week's sell-off. The next issue I'd like to talk about, aside from the uncertainty in China that seems to be paramount in people's minds, is the physically backed exchange traded funds planned by JP Morgan and BlackRock. It is still very far from certain if these funds will be approved by the SEC or indeed if there is an investor appetite for them. But they do have the potential to remove, in the first instance, almost, around 180,000 tons of copper. And that is half the LME stocks as they stand. And this would be material that would be stored on or off warrant and used as collateral against a new fund. If they are launched, and if they do prove to be popular, they will provide a second tier of consumption in the market, and that can only be bullish for prices. It will also be bullish for regional premia, depending on where the material will be stored. Those regional premia will likely be affected as that material is held and is unavailable to the market. The premia in the States have actually remained pretty firm this year, even with demand being sluggish, and it is largely due to external factors such as the availability of freight and therefore freight costs, as well as insurance. If this backwardation persists, it could change the market dynamics pretty significantly, and could also have an effect on negotiations for 2011 contracts. For now, though, the traders and the producers are looking for a rise of at least 1 cent for next year's contracts, and buyers do appear to be keen to lock in fixed premiums due to concerns about securing supplies, partly because of the planned ETFs, and because of concerns that spot premia may well remain firm or rise further. US buyers will also need to compete with Asian and European consumers, where Codelco is calling for a rise in premiums. This is at least what we are being told by the market. It is easy to divert material northeast and west from Chile, depending on where the best market is. So what does all this mean for copper and prices? In the long term, the substitution risks rise, of course. Plastic pipes, fibre optic and aluminium cables could get another push, and there is a demand destruction. Ambitious copper-intensive infrastructure projects may get postponed on cost overruns. That said, yesterday's news from Norilsk Nickel that it plans to invest over $2 billion in developing copper deposits in Russia shows the power of the higher prices in persuading companies when making investment decisions. And I suppose that all goes back to what Tom Albanese was saying this morning, that there is a lag, and that lag, the miners will eventually catch up, and one would hope that the amount of ore coming out of the ground will match the smelting demand. In the short term, though, many say that the market has got ahead of itself and the fundamentals, and they point to a number of factors that support that argument. Stocks have stabilized. They fell from their peaks in February, but they have stabilized. China has not been buying much since August. Physical premiums in Shanghai have plunged, and the scrap spreads have widened as demand has remained weak. Furthermore, China's SRB is selling aluminium and zinc from its strategic stockpile, and so what's to say that they won't start offloading some of their copper reserves? Those arguments all go into the mix, and fundamentals may have taken a back seat, but they are still providing support to the market. But The main feature, as you have all probably been, you're all very aware, is quantitative easing, which is driving the dollar weaker, and the QE2 with worth $600 billion is going to increase the supply of dollars and prevent a recovery in the coming months. That's how the argument goes. Analysts say that the metals with the strongest fundamentals, the metals where fundamentals are the strongest out of other markets are likely to see the biggest impact from this tide of money. Under the first round of quantitative easing and the weakening of the dollar, prices rallied from $6,000 per ton in June to close to $9,000 per ton. So does this mean that prices will hit 12,000 in the next 6 months? And if they are to go to 12,000, then how far must the dollar fall? Well, QE2 is going to run until June, so there is every possibility of a continued rally. Ahead of the year-end, traders are expecting some profit-taking, and I suppose you could argue that what we saw yesterday was a pretty hefty bout of it. And at the same time, we saw the dollar. We've seen the dollar recover today on the back of the Eurozone concern. So any kind of profit, the traders say that any kind of profit taking could be short term, and Metal Bulletin research says that prices could indeed hit $12,000 per ton in the second quarter of next year. And a glance at the forecasts from the banks and the brokers for the average cash prices next year, it could easily take your breath away. The lowest forecast on that table is 7,900, and the highest is a whopping $11,250 per ton from the Bank of America Merrill Lynch. Metal Bulletin research, which has been on the more bullish side in the recent years, is actually at the low end of the spectrum with that $7,900 per ton. Their base price is $8,282. With a high of 9,200 and a low of 7,400. For 2012, they see prices rising as high as 10,000 and a low price of 6,600. And while that sounds like respite compared with the current market, 6,600 is still a very high number, as you all know historically. So the fact is that while interest rates are at historic lows, investment funds are likely to continue to plough money into base metals and copper in particular. That the return on their investment is so much better than any other market. At the same time, banks are trying to get in on the act, setting up physical trading desks and buying their own warehousing companies. Others, the other bulls in the market focus on the concentrate shortage and its impact on smelting capacity, the potential for the prolonged weakness of the dollar, the lower visible inventories, the long-term healthy growth of China, and the potential launch of the ETFs. That combination has whipped up quite a frenzy in the market and led to the record prices last week. It was interesting last week to see that the producers were selling into those high prices, which perhaps is an indication that they see the top of the market at around $8,900 for now. That frenzy is pretty nervous, and any sign that China's government and their efforts to prevent their economy overheating and signs about the Eurozone economy could seriously dent sentiment. Now, after the sell-off earlier this week. We've seen evidence of that. The prices have recovered slightly this morning. There's a bit of a bounce going on at the moment, but I'm not sure that investors can see the wood from the trees, and until there is some clarity on the Eurozone, there's not likely to be a let-up in the short term. There could be, analysts and economists are expecting an aid package for Ireland should it be needed, but Spain, Italy, Greece and Portugal may still need help, and hence we saw the dollar break out of from its lows yesterday. The Chinese Premier Wen Jiabao has warned on state television yesterday that the government is putting together measures to address inflation, which is at a 2-year high. He didn't give any details, so until that clears up, expect some volatility and nervousness. The UK Prime Minister Harold Wilson in the 60s said, "A week is a long time in politics," in reference to the fortunes can change, how the political fortunes can change very dramatically. I suppose the same could be said for the metals market as it is at the moment. But I would be very happy to take any questions if you have any. And I thank you very much for listening to the thoughts of a reporter looking in on a very dramatic market.
Yeah.
Thank you very much.
Yeah, thank you very much, Josephine. And like she said, we are taking questions. Go ahead and use the question tool on your webinar toolbar. I do have a couple of questions here. First, any prognostications of ranges for copper? Ranges for copper would be of interest. Are other commodities expected to track copper too?
Okay. Well, I suppose the prognostication for copper, personally I would be hesitant about giving my own personal opinion about where prices are going to go, but as I said, that the nervousness in the market I think is going to cap things in the short term, particularly as the end of the year approaches. Now, going back to the table that shows you where analysts who have very large abacuses and put together their forecasts for supply, demand, and put it all into a melting pot and come up with a magic number. The table at the end of the presentation it shows the wide range of the forecasts. I would say that it's worth remembering that at the beginning of this year forecasts were for below $6,000 to $7,000 per ton, and already at the end of October we were at an average of 72, and so analysts will admit themselves they can't predict the future as well as they'd like, but I think the ETF will cause has certainly caused quite a stir, particularly because of the amount of material it could tie up in funds. The outcome of the Eurozone, the nervousness about the Eurozone and China will weigh in the short term, but as Metal Bulletin Research predicts, in the long term China is still going to need a huge amount of copper, and that will fundamentally provide great support to the market. So that hasn't quite given you a very definitive answer, I know, but after yesterday's sell-off, it's a tough one to call.
That's right. It's anybody's guess, I'm sure, but it is on another topic where you mentioned earlier how difficult it is to operate in countries like Zambia and Congo and areas like that. I think that's obvious why it's difficult to expand exploration, but what effect has the lack of financing over the last couple years had on exploration, and is that changing around now that it appears copper mining is a good investment?
Yes, for sure. In 2008, the amount of financing that was withdrawn at the overnight for projects was quite phenomenal, and with the part of the reason for the banks pulling that funding alongside the interbank, the lack of interbank lending, was that the copper price fell very sharply, and a lot of mines were operating at below their cost of production and were forced to close. Now, with the rise in the copper price, projects are able to show, when they're looking for project financing, they're able to show the banks where the price of copper and how much higher it is than their own cost of production, and they're able to hedge at those higher prices and protect themselves from any kind of market collapse. And it goes back to the Norilsk news yesterday, that they're going to spend $2 billion on a new. Have you just lost me? I think I just pressed a button.
Nope, I think you're still there. I can still hear you. Josephine?
Hello.
Am I back with us? I think you're
sorry,
back.
I pressed a button that I shouldn't have.
I think you are back with us. Yeah. Okay.
Yeah. But you only need to look at, I suppose, rare earths is a good example of an explosion in exploration. The rise in prices in rare earths has encouraged a lot of companies to relook at deposits that weren't economically viable a few years ago, and I think we'll see plenty of that. With copper, it really does depend on the security of the countries such as Congo. Freeport has Tenke Fungarumi, and I think I've probably pronounced that name incorrectly. I usually just call it Tenke in Congo. They appear to have dealt with the insecurities in the Congo pretty well, but others, such as First Quantum, have had their projects taken away from them, and the reasons for that are still unclear, and for between First Quantum and the government. You've also got the Oyu Tolgoi in Mongolia, which is causing its own insecurities as well. So the problem with copper is that they're in risky areas, and you can't guarantee that infrastructure or political security, and it's part of the reason that the Chinese companies are crawling all over the Congo. They are offering to build infrastructure in return for having ownership of deposits. Anyway, that's a very long-winded answer.
We do have another question here. How long will it take to put the ETFs together?
Well, that is a good question, and I'm not sure even I'm not sure even the guys who are planning the ETF know themselves. They were filed with the SEC about 3 weeks ago. They will now need to wait for the SEC to respond, and I suppose depending on that, the response from the SEC, they will then pursue it. My understanding was that they were looking for the first, by the end of the first quarter next year, but that is very dependent on what the SEC comes back with. And it is still very unclear whether they will get approval.
Okay, more questions there.
And I should add that it's still unclear whether the material for those ETFs has been stockpiled already,
okay.
whether it'll be bought as a result of once it gets approval.
All right, here's another one. We have heard of many newfound deposits. How long do they take to develop to change the supply? And why are the African deposits so difficult to utilize?
Yeah, that's a really good question, and there is well, as the NBR research says, there's a 5 million ton gap between what is required, the mining capacity that's required, and the amount that is projected to come on stream. So the pipeline is pretty empty. Now, a project takes years and years, several years from finding the deposit to developing it. I was in Eritrea in January, where there was the country's first ever copper mine is going to start producing any minute now, in fact, and it's run by a company called Nevsun, and they're a Canadian firm, and they have been working in Eritrea for, I think they've been there for about 8 years, trying to get this deposit off the ground. Now, obviously, 8 years ago, the price of copper was significantly lower than it is now, and so not as the project was not as attractive. But governments are becoming more savvy in understanding that they need to secure and look after their natural resources, and while foreign companies can come in and develop those deposits, they understand that they want, quite naturally, a return. They want a piece of the pie, and so negotiating with governments can take a long time in itself. So it's not just working out how to dig the ore out of the ground. There are royalties and taxes to negotiate. So I can find, if the person who asked that question would wants to give their details, I'm very happy to get an estimate for how long it will take to fill that gap, based on well, but I can't forecast that myself off the top of my head. But I do know that you really need to look at Oyu Tolgoi and projects like the Nevsun Bisha mine in Eritrea to know that there are many risks that can crop up that are totally unexpected.
All right. Another forecasting question here, but how could copper scrap supplies and pricing be affected in the next 6 months? Well,
I assume that the person who's asking is referring to the U.S. scrap price, and the major influence will be China, and when China returns to buy. The other issue, interestingly, is that the and the weakness of the dollar is encouraging exports. So if China comes back to buy, then you'll see a shortage of material, and therefore a rise in price. But as I said, with the Chinese New Year in February, it could be said that they will not necessarily need to buy very much until after their national holiday, and so that's well into the first quarter. So you may well see some respite for the next 3 or 4 months. Over the longer term, as China becomes a more sophisticated player in the recycling market, and as its economy grows, and I'm thinking very, very long term now, but their own internal recycling rate will increase, and their dependence on external supplies will reduce. It's a very young scrap industry, and they don't have actually very much. They don't generate very much material for recycling, which is why they have to import so much. So but as their economy grows, and as they buy air conditioning units and buy cars and fridges and freezers, then that industry is going to mature, and you'll probably or you may well see their buying slowing over the years. That's a long way off, but
this is more of a general market question, but what index has the closest correlation with copper? GDP, other commodities, oil? Do you see any correlation between other markets?
Well, I suppose the correlation that you could probably watch what dollar does, and copper will do the opposite. Now it broke out of that recently, couple of days when it broke out of that pattern, but the sell-off in copper yesterday coincided with a recovery in the dollar. You can also see a correlation with oil. With other, it doesn't necessarily follow other metals. It's considered the benchmark, and you could say that all the other metals follow copper. The GDP figures are trickier just because it depends on the country, and the LME would say that their copper price is a global price, and therefore reflects global market. But I would be happy to pass that person on to MBR if they wanted to talk further on that.
Okay. Now this appears to be the final question.
Wow.
Are ETFs likely to make the market more volatile? Just the impact on price, but we were wanting to know about volatility here.
Yeah. Well, I look at the ETFs in the same way that I do the financing deals that we've seen in aluminium in the last 2 years. We have stocks of aluminium at 4 million tons in the LME, and they're supposed to be a stockpile off exchange of a similar quantity, and a lot of that is tied up in warehousing deals, and so is therefore unavailable from consumers who need it. And that has pushed regional premiums for aluminium very, very high. But at the same time, it has actually created has created a great deal of volatility in the price. You've seen the squeeze on nearby spreads in aluminium, and you've seen a backwardation emerge. Now it was a very short. It was a very brief. It's been a brief backwardation that keeps returning, but part of it is caused by the unavailability of material in the immediate term. And in theory, if the copper ETFs are very popular, and I'm not saying they're going to be, but if they are, and BlackRock and JP Morgan need to stockpile more material, then in theory they will be taking available material off the market, and that could cause short-term squeezes and therefore spikes in the price, and therefore volatility, heightened volatility. That actually the greater volatility is probably going to come from the nervousness in the market in the immediate term about the Eurozone and China.
Well,
does that make sense? Does a person who asked that question have any follow-up on that? Because
I don't believe, no, he hasn't sent anything more. I can definitely hook you up with his name at the end of the presentation.
Yeah, great. Okay.
But he said that is fine. There
cool.
you go.
Okay.
Well, and I would just like to, thank all of our attendees today. We had some excellent questions, excellent participation for the first time out. This was really a great thing, and I definitely want to say thank you to Josephine for stepping up and being our first speaker with CBS. It's not as easy as it sounds out there in the world. It's a very big thing you did for us, and we really appreciate it, Josephine.
Oh, it's an absolute pleasure, and thank you so much, everyone, for some really good questions, some really interesting questions. And if anybody has any follow-ups, if I didn't answer a question sufficiently, then I'd be more than happy to do some digging and find out some numbers if people need them, or point them in the right direction for people to speak to.
Okay, and just as a matter of housekeeping, this will be a quarterly event starting in 2011. So the first month of each quarter we will have a web seminar for everyone. So pay attention to copper-brass.org or your email. We send out a mass email to all the members. Of course, if you have any topics you would like to see, you can send that to me. Again, my name is Wes Huddleston. I am the Education and Marketing Manager for CBSA. You can get my contact information on the association's website there as well. We did have some questions about having a copy of this presentation. Within an hour of the broadcast, you will receive a follow-up email with a short survey on it. If you answer the survey, there at the end of the survey, there's a link to a PDF copy of Josephine's slides. So you can print them, you can save them, you can have them after you answer our brief survey, because we do want to make this better continually. So if there is nothing else from Josephine, I believe that is the end of our broadcast and the end of our first CBSA web seminar.
Great. No, I have nothing else to say, but thank you very much.
Thank you very much, everyone in attendance, too. We'll see you in 2011.
Bye-bye.
Bye-bye.